According to Reuters, in September 2020, JP Morgan Chase agreed to pay a total of approximately 920.2 million US dollars to settle charges related to years-long manipulation of trading in the precious metals and US Treasury futures markets. This was one of the largest fines ever imposed in the history of modern derivatives markets. Also, according to Reuters, China's Ministry of Commerce recently announced a list of 44 companies authorized to export silver during the 2026 to 2027 period, accompanied by stricter licensing requirements than before. This move is not a complete export ban, but it reflects an important shift in how countries are beginning to view silver, no longer merely as a commodity, but as a strategic input within global supply chains. Taken together, these two pieces of information create an uneasy feeling for anyone following financial markets. On one side is the largest financial institution in the United States, previously penalized heavily for manipulating precious metals markets. On the other is the world's largest industrial economy, tightening control over the flow of silver into international markets. Viewed separately, each event can be explained as a technical or policy matter. But when they appear within the same time frame, the story becomes far more complex. Modern financial markets operate on assumptions. One of the most important assumptions is that assets traded on paper can always be converted into physical assets when needed. This assumption has held true for most of the time because the vast majority of market participants never actually demand physical delivery. They only need the price. But history shows that major shocks do not begin with collapse. They begin when confidence in a core assumption starts to erode. And in the current environment, the silver market is emerging as a place where that assumption is being placed under increasing pressure. What happens if silver is no longer traded merely as a number on a screen, but as a genuinely scarce physical asset? Remember this: if your right hand can hold silver in your palm, your left hand can absolutely hold a mouse. And click subscribe to the channel. Let's continue together. To understand why the silver market is under more pressure than usual, we need to begin with a basic question that is often overlooked. Where is the price of silver actually formed? The answer is not at bullion shops, nor at factories that use silver in production. For most of the time, global silver prices are established primarily in the futures market, especially on COMEX, the commodities exchange operated by the CME Group in the United States. On COMEX, silver is traded in the form of paper contracts. Each contract represents a standardized quantity of silver, with a commitment to deliver at a specified future date. However, the key point is this: the vast majority of these contracts never result in physical delivery. Buyers and sellers typically close or roll their positions before expiration. This system functions efficiently because it provides high liquidity and low transaction costs, as long as most participants are focused solely on price movements rather than taking delivery. Within COMEX's warehouse structure, silver is divided into two main categories: eligible and registered. Eligible silver meets the standards for storage but has not been designated for delivery. Registered silver is the portion that has been officially registered and is ready to be delivered upon request. This distinction is critical because only registered silver truly represents immediately deliverable supply within the system. According to publicly available data, COMEX silver inventory figures are updated daily and are often used by analysts as an indicator of supply-demand conditions for physically deliverable silver. This does not mean that every inventory fluctuation signals a crisis. Under normal conditions, the amount of registered silver moves with delivery cycles, reallocations between warehouses, and temporary shifts in market demand. Problems arise when the volume of paper contracts grows significantly faster than the amount of silver available for delivery, and when participant behavior begins to change. This pricing system rests on an implicit assumption that if needed, physical silver can still be mobilized to fulfill delivery obligations. As long as that assumption holds, the silver price on screens continues to reflect a relative balance between financial supply and demand. But if an increasing number of participants become unwilling to roll contracts forward and instead begin to seek physical deliveries sooner, the pressure no longer resides in price, but in the ability to honor delivery commitments. This is not a loud or sudden phenomenon. It unfolds through subtle signals: shifts in contract maturities, rising costs of borrowing metal, and growing market attention to the level of registered silver. The key question at this point is no longer what the price of silver is, but rather, what happens if more and more participants want not just to trade silver, but to actually own it? In most stable periods, the silver market operates according to a familiar routine. Futures holders typically close their positions before expiration or roll them into later months. This allows them to gain exposure to price movements without dealing with the logistics of storage, transportation, or insurance of physical metal. That habit has kept the contract-based pricing system functioning smoothly for a long time. But when pressure builds, behavior begins to change in very subtle ways. One of the earliest signs is an increase in the proportion of contracts that proceed to physical delivery. This is not common in a highly financialized market like silver. When more participants than usual choose to take delivery, the discussion shifts away from price forecasts and toward the system's capacity to meet delivery on time. Another signal is a shift in contract maturities toward earlier delivery. Instead of rolling contracts into distant months, some participants begin to favor nearer maturities. Technically, this reflects a rising value placed on owning silver now, rather than merely holding the right to purchase it in the future. In commodity markets, this is typically a sign of physical pressure, not simply a price expectation. At the same time, the cost of borrowing physical silver, often reflected in metal lease rates, has also become a noteworthy indicator. Under normal conditions, these rates are relatively low, reflecting ample supply and easy circulation. But when borrowing costs rise significantly, it signals that those who need silver are willing to pay more simply to secure the metal for a short period. This does not occur because of price speculation, but because real demand cannot be postponed. According to market reports, COMEX silver inventory data are updated daily and are closely monitored by analysts as an indicator of delivery system health. A decline in registered silver does not imply a market collapse, but it does narrow the system's margin of safety. As that margin thins, each additional delivery request carries a greater impact than before. The key point to emphasize is that these signals do not appear as a single shock. They accumulate gradually, quietly, and are often recognized only in hindsight when viewed as a sequence. Like a banking system, the problem is not one person withdrawing funds, but the moment when many people all want to withdraw real money at the same time. And when that happens, the question is no longer how silver prices will fluctuate, but rather, who actually has the ability to deliver silver when the market begins to prioritize physical metal over paper claims. In any market, especially a systemically important commodity market, the search for a manipulator often leads to emotional conclusions. Serious market analysis, however, does not begin with looking for a villain. It begins with observing behavior. And in the current silver market context, JP Morgan should not be viewed as the central character of the story, but as an important behavioral indicator. According to Reuters, in September 2020, JP Morgan Chase agreed to pay a total of approximately $920.2 million to settle allegations related to years of manipulative trading in precious metals and U.S. Treasury futures markets. This was a serious event and was widely documented. However, it is important to clearly distinguish between past misconduct and trading practices, and JP Morgan's current role within the structure of the silver market. That penalty was not accompanied by a ban on the bank's participation in physical silver custody or delivery. Within the COMEX system and the global metals market, JP Morgan plays a significant role as a custodian and as one of the most frequent participants in physical silver delivery. The custodial role means that the bank holds silver on behalf of clients, funds, and other institutions. This is often mistaken for owning all of that silver. In reality, most of the silver stored in custodial warehouses is owned by many different parties, but control over the flow and the capacity to facilitate delivery is concentrated in the hands of a small number of large institutions. What draws analysts' attention is not the absolute size of silver inventories, but JP Morgan's consistent delivery behavior during periods of market stress. When delivery requests increase and registered silver becomes the focal point of scrutiny, JP Morgan often appears as one of the entities capable of fulfilling large-scale deliveries. This does not prove any conspiracy, but it highlights an important reality. Not all institutions have the same level of access to physical silver. From a risk management perspective, a large financial institution maintaining the ability to deliver physical metal in an increasingly tight market is entirely rational. In an environment where most transactions occur on paper, the capacity to convert financial obligations into physical assets becomes a form of insurance. It is neither a price forecast nor a one-sided bet. It is how large institutions prepare for scenarios the market rarely has to confront. It is important to emphasize that JP Morgan does not control the silver market in an absolute sense. However, its behavior reflects a clear difference between how large institutions perceive risk and how much of the rest of the market continues to operate based on older assumptions. When some institutions prioritize access to physical metal over mere price exposure, it signals that the center of risk is shifting. And it is here that the key question is no longer what JP Morgan will do next, but rather, what risks are prompting large institutions to treat physical silver as a necessary defensive layer, rather than merely a paper trading instrument? For decades, the global commodities market has operated on a seemingly obvious logic. Raw materials are extracted where costs are lowest, refined where capabilities are strongest, and distributed to where demand is highest. This logic optimized costs, stabilized supply, and kept international trade running smoothly. But that logic is gradually changing, especially for strategic materials, and silver is increasingly falling into that category. According to Reuters, China's Ministry of Commerce has published a list of 44 companies authorized to export silver for the 2026 to 2027 period, accompanied by stricter licensing requirements than before. This is not an outright export ban, but it is also not a mere procedural adjustment. It reflects how China, like many other countries, is redefining the concept of supply chain security. In the context of rapid growth in renewable energy, electric vehicles, electronics, and digital infrastructure, silver is no longer just a commodity traded on international markets. It has become an essential input for industries that governments consider strategic priorities. As domestic demand rises quickly, retaining more supply at home becomes a rational policy choice, even if it reduces the amount of silver flowing into global markets. What matters here is not that China is strangling supply, but that the flow of silver is no longer as free as it once was. When a major node in the global refining and consumption chain applies stricter licensing mechanisms, the international market must adjust. These adjustments rarely appear immediately in prices. Instead, they surface gradually through tighter conditions at delivery points, higher logistics costs, and precautionary stockpiling behavior by end users. Historically, major shifts in the geopolitics of commodities rarely begin with dramatic declarations. They begin with administrative documents, licensing lists, and new standards. Yet their consequences can last for many years. When upstream supply is held back, pressure is pushed downstream. Manufacturers, vault operators, and delivery markets are forced to adapt to a less flexible environment. In this context, silver does not disappear from the market. It simply stops flowing in the way the market has grown accustomed to. And when flows are constrained, even small changes in demand can generate much larger impacts than before. This is especially significant for a market of relatively modest size like silver. The question now is not whether China's policy is right or wrong, but rather, when countries begin prioritizing the retention of strategic materials, how much strain will the global distribution system come under, and who will feel that strain first? For decades, silver has often been viewed through the lens of gold. It has been grouped among precious metals, compared via price ratios, and traded as a smaller, more volatile version of gold. That perspective made sense in a world where silver primarily functioned as a financial asset. But that world is changing far faster than many realize. Unlike gold, silver increasingly resembles an infrastructure metal. It is embedded in core sectors of the technology-driven economy: solar panels, electric vehicles, next-generation telecommunications networks, and data centers supporting artificial intelligence. Silver is not merely a good conductor. It is the most electrically conductive material found in nature. This makes substituting silver in critical applications extremely difficult, if not practically impossible at scale. The key point is this: industrial demand for silver does not rise and fall with typical financial cycles. It grows in line with the pace of technological deployment and energy transition policies. When governments commit to expanding renewable energy, and when technology companies invest billions of dollars in data infrastructure, silver demand becomes a near-dash hard variable. It cannot easily contract simply because prices rise in the short term. Meanwhile, the supply side of the silver market faces clear structural constraints. Most of the world's silver does not come from primary silver mines, but rather as a byproduct of copper, zinc, and lead mining. This means that even when silver prices rise sharply, production cannot respond as quickly as metals with independent supply chains. Decisions to open new mines, expand capacity, or invest in exploration typically take many years to translate into actual output. This mismatch, rapidly rising demand while supply responds slowly, creates an environment very different from previous precious metal cycles. Silver is no longer merely a financial hedge, nor is it just an industrial commodity. It has become a hybrid asset, simultaneously influenced by investment flows and constrained by production demand that cannot be deferred. It is precisely this hybrid nature that challenges the current pricing system. Traditional models, which rely heavily on the relationship between silver and gold or on speculative cycles, may no longer fully reflect the new reality. As silver is consumed in indispensable products of the digital economy, each ounce represents not only stored value, but also the operational capacity of an entire technology chain. This leads to a pivotal question. If silver is no longer a precious metal in the traditional sense, but a component of modern economic infrastructure, is a pricing system based on paper contracts still suitable to fully reflect its evolving role? Whenever the silver market becomes strained, a familiar comparison resurfaces: the story of the Hunt brothers in the late 1970s. At that time, the two investors accumulated an enormous quantity of silver by the standards of the era, contributing to a sharp price surge before the system reacted forcefully and reversed course. The outcome was a rapid price collapse and severe losses for those who had taken oversized bets. For many, that episode became proof that silver cannot be cornered for long. However, directly applying lessons from the past to the present context can lead to misleading conclusions. What matters is not comparing outcomes, but comparing structures. In the Hunt brothers' case, most positions were built using financial leverage. When regulations changed and margin requirements rose sharply, liquidity pressure forced them to sell under unfavorable conditions. The market reacted not only because of the scale of accumulation, but because of the fragility of the financial structure behind it. Today's context differs in several key respects. First, the silver market is now deeply embedded in global supply chains, particularly in high-technology industries. Demand no longer comes primarily from financial speculation, but from sectors with long-term production plans and far less flexibility in substituting raw materials. This fundamentally alters the market's response when supply is constrained. Second, market participants today operate within a far more rigorous risk management environment. Gaining access to physical silver, rather than merely building paper positions, reflects a defensive approach very different from the high-leverage model of the past. This does not guarantee that volatility will be avoided, but it does change how that volatility propagates through the system. Finally, the role of policy and geopolitics in modern commodity markets is far greater than it was a few decades ago. Decisions related to supply chains, exports, and resource security impose constraints that past cycles of purely speculative activity did not have to confront. History does not repeat itself in full, but it leaves traces of behavior and structure. And it is precisely within these structural differences that the key question is no longer whether the silver market will repeat 1980, but rather, how will the current system respond when old assumptions no longer align with new realities? Any serious market analysis must make room for counter scenarios. Identifying risks does not weaken an argument. On the contrary, it helps distinguish grounded analysis from emotionally driven narratives. In the case of silver, there are at least three categories of risk that must be put on the table. The first risk is policy intervention. History shows that when commodity price volatility threatens production activity or financial stability, regulators can act swiftly. Measures may include adjusting trading rules, raising margin requirements, or intervening in circulation mechanisms. These actions are not necessarily intended to suppress prices, but they can alter market dynamics in the short term and trigger sharp corrections. The second risk stems from cyclical economic weakness. In a deep recession scenario, industrial demand may decline, particularly in growth-sensitive sectors such as infrastructure construction or equipment manufacturing. This could slow the pace of silver consumption for a period of time. However, it is important to note that recessions are also often accompanied by stimulus policies and increased demand for financial hedges, creating countervailing forces. The final outcome depends on the depth and duration of the downturn. The third risk involves technological substitution and corporate adaptation. At sufficiently high prices, companies have strong incentives to invest in alternative materials or to optimize processes in order to reduce the amount of silver used per unit of output. While silver has properties that are very difficult to replace, industrial history shows that no material is entirely immune to innovation pressure when costs become a significant constraint. In addition, the emergence of new supply over the long term cannot be ruled out. High prices encourage exploration and investment, but this process typically takes many years before meaningful production comes online. During that interval, the market must continue to operate under existing constraints. These counter-scenarios do not negate the pressures forming in the silver market. They serve as a reminder that the path forward is rarely linear. And it is precisely at the intersection of structural pressures and these opposing forces that the central question emerges. Will the market adjust through price, through policy, or through a deeper restructuring of the entire trading system?